Hello, Brian Linchey here with your quick mortgage and housing market update. If you're thinking about buying a home, refinancing, or just wondering where mortgage rates are headed, today's economic updates actually carry some encouraging signals for the housing market. Despite some geopolitical worries between the US and Iran pushing oil prices higher, mortgage bonds started the day slightly positive. That's important because stronger mortgage-backed securities usually help keep mortgage rates from spiking. Let's look at the big picture. The second reading of Q1 GDP came in weaker than expected, dropping to just 1.6% growth. A big chunk of that number was driven by AI-related build-out, which means the rest of the economy is showing even more softness. Slower growth can eventually take pressure off inflation and support lower bond yields, which is good news for mortgage rates over time. On the inflation front, the April PCE report, the Fed's favorite inflation gauge, was actually a bit cooler than Wall Street expected. Headline inflation rose, but less than feared, and core inflation, which strips out food and energy, only increased 0.2% for the month. Even with some temporary shelter-related bumps from data delays, the underlying numbers are behaving better than many anticipated. This balance is helping support the bond market, even with the disappointing growth news. Other data today showed some mixed signals. Durable goods orders looked strong on the surface, but were inflated by big aircraft orders. The core number actually fell, pointing to some slowdown in business spending. Initial jobless claims ticked up slightly, but remain at very low levels, which is still a healthy labor market sign. What does all this mean for you? Mortgage bonds are currently trading in a wide range, and rates are relatively stable for now. The 10-year Treasury yield is sitting right in the middle of its recent range. If we continue to see softer economic data and inflation that stays contained, this sets the stage for potentially more favorable mortgage rates ahead. Higher oil prices and global tensions are the wild cards that could create some volatility, but the combination of cooling inflation pressures and a slowing economy is generally a net positive for the bond market and housing affordability longer term. If you're in the market for a home or considering a refinance, now is a great time to talk to your lender and get locked in on current rates before the next big moves. Rates can change fast, so stay informed. Thanks for watching. Drop a comment and let me know if you're buying, selling, or refinancing right now, and hit that like button if you found this helpful. I'll see you in the next update.